3 weeks ago, markets were expecting 0 rate hikes in Canada. And today, they're pricing in up to 3 rate hikes. Same economy, same country, same data. So what changed? And more importantly, what does this actually mean for you if you have a mortgage or if you're planning to buy? Because right now, there's a massive disconnect between what the headlines are saying and what the Bank of Canada is signaling, and what's actually happening under the surface. And if you don't understand this properly, you could make a mortgage decision that could cost you thousands of dollars. If you're new to my channel, I'm Evangeline, mortgage broker and partner at All Trust Mortgage Solutions here in Greater Vancouver. And if you find this video useful, don't forget to hit that like and subscribe button. Let's start with what actually changed. This entire shift in rate expectations didn't happen slowly. It happened fast. A major trigger was geopolitical tension, specifically conflict involving Iran, which impacted Strait of Hormuz. Now, why does that matter? Because roughly 20% of the world's oil supply flows through that region. Oil prices spike, inflation expectations rise, and that immediately impacts bond yields. And in Canada, that matters a lot because bond yields directly affect fixed mortgage rates. So while the Bank of Canada hasn't raised rates, borrowing costs have already started moving. And here's something that most people completely missed. When the Bank of Canada held rates, they didn't just pause. They actually warned that if inflation spreads beyond energy, they may need to move into consecutive rate hikes. So while headlines focused on rates are stable, the underlying message was very different. Most people think if the Bank of Canada pauses, mortgage rates stay the same. That is completely wrong. There are two completely different systems. There's variable rates directly tied to the Bank of Canada, and then there's fixed rates driven by the bond markets. And right now, bond yields have jumped about 80 basis points in under a month. That's massive. We even saw moves like 30 basis points in just 2 days. That's when fixed rates go from 4.09 to 4.3 to 4.5 or higher without the Bank of Canada even doing anything. Let me give you a quick example so this actually clicks. If you get a $600,000 mortgage amortized over 25 years, at 4.09%, your payment is roughly $31.85 a month. At 4.5%, it jumps to $33.20 a month. That's almost $135 more per month. And this can happen without a single Bank of Canada rate hike. And here's the key. Bond markets don't wait for the Bank of Canada. They move ahead of expectations. So by the time rate hikes actually happen, fixed mortgage rates have already adjusted. So if you're sitting there waiting for the Bank of Canada to move before making a decision, you're already behind. And one more thing most people don't realize is not all variable mortgages behave the same. Some have adjustable payments, where your mortgage payment goes up as rates rise, and others have fixed payments, where your payment stays the same, but more of it goes toward interest. And eventually, you can hit something called a trigger rate. That's where your payment no longer covers the interest. And that's when lenders step in and force an increase. That's where people really get caught off guard. Now here's where it gets interesting, because even the professionals don't agree. Markets are pricing in 2 to 3 rate hikes. Some banks like Scotia and National are expecting plus 50 basis points, while others such as TD and CIBC are expecting no rate hikes at all, even into 2027. CMHC is expecting variable rates to rise into 2026, and mortgage analysts are saying variable rates could increase by 1 to 1.5% by 2027. So let's be clear, there's no consensus. And that matters because when people pretend that rates are obviously going up or rates are obviously going down, that's not analysis, that's guessing. And this is where I'm going to be direct. You should not blindly trust bank forecasts, headlines, or even the Bank of Canada. Not because they're wrong, but because they're not making a decision for your situation. We already saw this in 2022. Banks were projecting minimal rate hikes while inflation was already running hot. At the time, real interest rates were actually negative, meaning borrowing was still being encouraged, even as inflation was rising. So the system wasn't just reacting late, it was actually amplifying the problem. If they had been fully transparent and aggressive in their forecasts, more people would have locked into fixed rates around 2.7%. Let's put that into perspective. Banks underestimated rate hikes in 2022. If they had been more accurate, more borrowers would have locked in at a lower rate. That would have shifted interest rate onto banks, reduced bank profitability, lowered value of their mortgage portfolios. So yes, there are incentives in the system, and you need to understand that when you're making a decision. The system isn't neutral. You need to think for yourself. Now let's zoom out because this is where most people are completely missing the bigger picture. Right now in Canada, we have something very unusual happening. Population is actually declining. For the first time ever on a year-over-year basis, we've had over 400 to 470,000 non-permanent residents leave, and the government trying to reduce that segment from 7% to 5%. And that matters because for the last decade, population growth was one of the biggest drivers of housing demand. Now that's reversing, and here's how it impacts housing. Vacancy rates are at a 30-year highs in places like Vancouver. Rents are down 9% year over year. down 16% from the peak and falling for 26 consecutive months. That is not a strong housing market. As for the labor market, unemployment is at roughly 6.7%, and youth unemployment is at a 35-year high. So let's connect the dots. We have 1, weak demand, 2, population decline, 3, soft labor market. And at the same time, markets are pricing in rate hikes. This is the real issue. The Bank of Canada is stuck because they have two competing problems. Problem 1, inflation risk driven by oil and geopolitics. Problem 2, a weak economy that can't handle aggressive rate hikes. And here's the truth. Raising rates to fight oil-driven inflation doesn't actually fix the problem. You can't control global oil prices with domestic interest rates, but you can damage your economy by over-tightening. That's the risk. Now let's talk about the real issue. And this is the part that matters most to you. 2026 is expected to be the largest mortgage renewal wave in Canadian history. We're talking about over 1 million mortgages, and as many of those were locked in at 1.5% to 2% rates, now they're renewing into 4% to 4.5%, maybe higher. Let's put that into a real example. If someone had a $600,000 mortgage at 1.8%, their payment was around $24.80 per month. At 4.5%, that jumps to $33.20 per month. That's an increase of almost $850 per month and over $10,000 per year. That's a massive payment shock. It's expected that many households renewing will see payments increase in the range of about 15% to 20%. And if rates go up further, that gets worse. Okay, so let's make this real. On a $500,000 mortgage, 0.5% increase means $130 to $150 more per month. At 0.75% increase will be about $200 plus per month. Let's take this one step further. If your rate goes from 3.5% to 4.25%, your payment goes up from about $2,500 to $2,700 per month. That's about $200 more every single month. That's lifestyle changes, budget stress, reduced flexibility. So when people say it's just a couple of rate hikes, no, it's not. Let's simplify this. There are really 3 scenarios. Scenario 1, which is the best case, oil drops, inflation stays contained, rates hold. And in this case, variable wins and stability returns. Scenario 2, moderate. Oil stays elevated, 1 to 2 rate hikes. Let's say that's a 0.5% total. On a $600,000 mortgage, that's about $150 to $200 increase per month. Variable advantage disappears and fixed rates rise slightly. In scenario 3, this is the worst case. Inflation spreads beyond energy, groceries, services, wages, housing costs. That's when the central bank gets aggressive. There could be 2 or maybe even 3 or more rate hikes. Let's say that's a 1% total. So on a $600,000 mortgage, that's about a $300 to $400 a month increase. Variable becomes expensive, fixed rates move higher, and the economy slows further. And here's my opinion. You don't need to predict which one happens. You need to be prepared for any of them. And this is where most people get it wrong. They try to guess the market. That's not the goal. The goal is to make a decision that you can live with, even if you're wrong. So ask yourself, can I handle $200 to $300 more per month? Am I planning to move in 2 to 3 years? Do I need stability or flexibility? Here's my stance. If you are tight on budget, first-time buyer, or renewing soon, I would strongly consider fixed. Because stability matters more than trying to win on rate. If you are financially strong, have flexibility, short-term plans, then variable can still make sense. But only if you're prepared for volatility and uncertainty. And to be fair, historically, variable rates have actually outperformed fixed rates the majority of the time over long periods. But that's only if you can handle volatility in the short term. And one thing that most people don't consider is what happens if you need to break your mortgage early. Variable rate mortgages typically come with a penalty of about 3 months interest. That's it. But fixed rate mortgages can have something called an IRD, which is the interest rate differential penalty, which can be tens of thousands of dollars depending on your timing. So this decision isn't just about the rate, it's also about flexibility. Okay, so here's what smart borrowers are doing right now. Number 1, getting 90 to 120-day rate holds. Number 2, running scenarios at plus 1% higher. So if your payment today is $2,500, test it at $2,800 to $3,000. Number 3, considering 3-year fixed instead of a 5-year. Number 4, not auto-renewing with your bank. Number 5, using a mortgage broker to shop lenders. Because one major update a lot of people don't know about is as of recent rule changes, when you're renewing your mortgage, you can often switch lenders without having to requalify under the stress test. This gives you a lot more flexibility to shop around. At the end of the day, this isn't about guessing where rates go, because clearly even the experts don't agree. This is about making a decision that protects you no matter what happens next. So if you're buying, renewing, or just unsure what to do, book a call with us through the link in the description, and we'll help you run the numbers to figure out what actually makes sense for your situation. Because in this market, the worst decision you can make is not having a strategy at all. I'd love to know what your rate strategy is in 2026, and if you've had a mortgage, what your experience has been in choosing a variable or a fixed rate. Let's continue the conversation, so drop your questions or comments below. Thanks for watching.